now.
Good morning, everyone. This is John Thomas, the Mad Hedge Fund Trader, broadcasting to you live from Silicon Valley, California. It's a somewhat cloudy day. We're expecting a rainstorm tonight, and boy, do we need the rain. We're having the worst drought in history. So pretty soon, water is going to be more expensive to buy than a beer at the local bar. So anyway, let's see. Let's get this thing going. So take out your pen and paper to take notes or start typing into your smartphone. What I'm about to tell you will blow you away and change your life. For I am in the early retirement business, not just mine, but yours as well. Why listen to John Thomas? Well, I have 53 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo and later the White House. And let me turn this sound down a bit. 10 years running the International Equity Division at Morgan Stanley, Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 14 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry. Take my half-century of trading experience and add it to your own. Learn from my trading mistakes. You don't have to repeat them, and believe me, there have been plenty. And if you ever need a ride in a 100-year-old biplane, I'm your guy. That's me flying over Malibu on the California coast. So the reason you're attending this presentation today is because of, let's see if I can get my Mad Hedge Profit Predictor. That is my secret weapon for the market, my market timing index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. It took 1,000 hours of calculations by a team of mathematicians to come up with this algorithm, and it's the most effective algorithm I have ever seen at work in the markets. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you are trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your profits. And I'm not the only one using algorithms. Some 80 to 90% of all trading in the market is being done by algorithms. If you're a human trading in the market, you're the rare exception. And this is 3 years of our market timing index calls. You can see we get lots of buys at market bottoms, lots of sells at market tops, enough action to get several round trips a year. Running this thing is like running a printing press that prints out $100 bills. So what happens when Goldilocks moves in? Well, our trailing one-year return as of yesterday was 68.89%. And that's against the Dow average, which is up only 20% over the same time period. So we're beating the Dow by about 4 to 1. And if you think I was just lucky last year, this is a 14-year return. We've averaged 44.36% a year for the last 14 years. And this actually kind of understates what the algorithm can do, because we only started using the algorithm in our trading about 4 years ago here. And that's when our returns essentially doubled over the long term, or we're doing 2 times the S&P 500. So what goes into the algorithm? Well, you know, if I told you, I'd have to kill you, and I wouldn't want to do that from Silicon Valley. But I'll give you just a smattering of some of the data points that go in there. Of course, there are thousands to choose from. We decided to focus on the 30 that have the greatest market impact, and those would include the 50 and 200-day moving averages across all markets and industries, the volatility index or the VIX, the junk bond treasury bond spread against the TLT, stocks hitting 50-day highs versus 50-day lows, the McClellan volume summation index, 20-day stock bond performance spread, stocks with rising versus falling volumes, relative strength indicator, 12-month US GDP trend, and the Case-Shiller S&P 500 National Home Price Index. I could go on and on. There's really just so much data out there these days. You really have to cherry pick and focus on the ones that'll give you the greatest benefit. So if you're going to spend some time with me, who the heck is John Thomas and why should I be listening to him? Well, if you're going to spend the next hour, my family origins are very humble, growing up as the oldest of 7 children on a remote farm in Southern California. I lived the all-American childhood, playing Little League baseball and becoming an Eagle Scout. There wasn't much to do in rural California in the old days, but hunting, so I picked a job as a paper boy for the Los Angeles Herald-Examiner. I found the stock pages, bought IBM at $20 and sold it at $30, and suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I'd visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions killed. I didn't see a future in that, so the government sent me to Southeast Asia for a few years of research, where I learned to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. At the end of 10 years of government service, all I got was this box of medals, which I trot out once a year on Veterans Day. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. Ta-da, enter the stock market. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. I figured out very quickly you didn't have to be that smart to make money in the stock market. Otherwise, the stock market would have run out of smart people a long time ago. So I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund. And that's me in Japan in the 70s, losing the All Japan National Karate Championships. Never enter a karate final with a broken wrist, which I did. As I rapidly became the top performing hedge fund of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You get to do things like buy the latest hot car, fly your own private plane around Europe, go marlin fishing in Mexico, and collect vintage Rolls Royces. That's my 1925 silver Ghost. I sold my hedge fund in 2000, retired to go into the oil and gas industry. After making a killing there, I missed the stock market and started the diary in 2008. I now spend my days pursuing my first love, finding winning trade alerts, but now I do it for my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There's far more satisfaction leveling the playing field for the average guy and teaching him how to trade, and that includes you. If I can take a $50,000 account and turn it into $500,000, that is far more job satisfaction than I could ever get anywhere else. However, every silver lining has a cloud. I had to pay $8.2 million in taxes in 2020 on $20 million in trading income. I just thank goodness I can pay it without having to take a dent in my lifestyle. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. If you see an old plane flying loops over San Francisco or London, it's probably me. The ultimate luxury, of course, is to give to those who need it. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans, and am a major donor to wounded warriors. When the wildfires hit California, I visited the main evacuation centers and handed out $10,000 worth of Target gift cards. So 2022 is looking even better. The US economy will be 8% larger in a year. US company sales will be 15% higher. Profits will explode by 34% or more. The operating leverage of US firms is the highest in history. COVID has peaked. Roaring 20s is here. The time to load the boat with stocks is coming in the next few months once we finish out the current correction. There is a method to my madness. Bond prices have peaked, interest rates have bottomed. The next to come is a multi-year bear market in bonds and the greatest short selling opportunity of the decade. Inflation plays are making a comeback now, like commodities and industrials and energy stocks. Keep your tech stocks, as out of your earnings are being wildly underestimated. Tech always comes back. The economic recovery is now regional, with China first, then the US and Europe last. Bitcoin won the battle at 2,000 and rallied an instant 50%. May try another attempt at 30,000 because of high energy prices, but that'll be a buying opportunity. If you're wondering why I was in such a good mood in that last picture, this is me flying a P-51 Mustang, a World War II fighter. I tend to get around a lot in the aviation community. So the global economy, inflation is soaring. We saw 8.5% last week, a 40-year high. Fed just declared war on the stock market, threatening to buy back, threatening multiple back-to-back 50 basis point rate cuts and accelerated quantitative tightening, not easing, quantitative tightening. QT will be the new terminology of the decade. Used car prices are taking a hit as affordability becomes a major issue. CarMax just reported a 6.5% plunge in Q4 sales. Producer price index rocketed by 8.2%. Retail sales up. Weekly jobless claims are at 185,000, looking to head to new all-time lows against this incredible labor shortage that we have. By the way, you don't have recessions and incredible labor shortages at the same time. One of those does not belong in this picture, and I believe it's the recession call that's becoming increasingly popular these days. The seminal investment theme of our times is, of course, technology. Since World War II, tech has rocketed from 1% of stock market capitalization to 27%, and it's on its way to 90%. Eventually, all companies will become tech ones or cease to exist. Over 50% of all new retail sales have been online since 2020, with one company, Amazon, accounting for half of that growth. The earnings of tech companies are growing at double the rate of non-tech ones, and profit margins are growing exponentially. The technology sector has been the top performer since the 2009 market bottom, will continue to do so for the rest of this decade. And a lot of these babies have dropped anywhere from 50 to 90%. Must-own sectors in tech are artificial intelligence, cloud-based applications, cybersecurity, autonomous driving, digital commerce, digital infrastructure, big data, 5G, microprocessors and GPUs, semiconductor manufacturing equipment, fintech, smartphones, blockchain, and quantum computers. So let's put our algorithm to work here and see what calls it's making. And as of now, we're looking for a double bottom right around the 410 level. That would take us down 17% from the high that we saw in January. And then you want to load the boat, because after that, we're going to new all-time highs sometime by the end of the year. So you'll load the boat on any big sell-off and then ride the rally for the second half of the year. We're looking for a highly volatile risk-off type first half of the year, and then a steadily rising market for the second half. So we run barbell portfolios here at Mad Hedge. Those are 50% big tech, 50% domestic recovery, And that includes railroads, airlines, cruise lines, couriers, steel companies, banks, construction, credit card companies, hotel, casinos, and online ticket sales. Right now, big tech is about 38% of US earnings. That's why it has such a heavy weight. And of course, NASDAQ, we're also looking for the double bottoming situation there. We've been playing technology short since January, made a ton of money on the short side, covered our shorts down here, looking to re-challenge that low and then go to 18,000 by the end of this year. We're up about 25%. Microsoft has been one of the safe stocks in the market. It's down on the year, and again, looking to challenge this bottom here, load the boat, go to $400 by the end of the year. Apple, also the other safe stock in the market, after hitting an all-time high of 182.5, gave up the recent gain, challenged it again, failed. We're looking for another test of these lows and then up to $200 a share by the end of 2022. And Amazon, of course, another big 800-pound gorilla in the market. Again, we're looking for this bottom down here around 2,500, load the boat, targeting 4,000 by the end of the year or sometime in 2023. Alphabet, also another big winner. This is one of the 3 leading stocks in the market. Looking for it to bottom out pretty close to here. After that, it's a run to 3,000 at least. They have a near monopoly with 92% of all search, and 15% of the search is for travel alone. So look for a big travel boom this summer. Facebook, we see an opportunity here. It's been completely melted, down about 50% in 8 months. So, but down here at 190, all of Mark Zuckerberg's sins are fully priced into the market. We see a rally back up to 300. Salesforce, another big winner in the cloud area. Again, not too far from a bottom here. We see a possible $300 a share by the end of this year. Second half of the barbell bets on a massive global domestic recovery to continue until 2023. Upside potential for stocks is far greater than tech. Some of these have not moved for 5 or 10 years. Focuses on economically sensitive cyclical industries. Makes a great counterweight to high growth technology. We could spend all of the next 2 years rotating back and forth between the two groups. Of course, the leader there is Boeing. The 737 MAX is flying again. China returns as a major buyer after the Trump trade wars end. U.S. airlines now suffering from a major aircraft shortage. You notice yesterday, one of the top performing sectors were all the airlines. Banks, another big area of value in the domestic side of the market. They've been hammered. JP Morgan's gone from 170 all the way down to 126. We're looking for $200 a share by the end of this year. Visa, of course, when you have inflation, the price of everything goes up. When the price of everything goes up, Visa fees go up. So that works pretty well. And again, looking for this sell-off to finish, targeting $300 a year by the end of the year. Union Pacific, when you have recoveries, you have to move lots of big stuff, especially between the center of the country and the east and the west coast. So looking for the sell-off in Union Pacific to finish and then go to $300 a share by the end of the year. Federal Express, another big winner in a recovery, looking for $300 a share there by the end of the year. And by the way, these boxes here, you can see where the algorithm sent out its signals. We had a buy here, buy here. This is Berkshire Hathaway. It's been one of our biggest winners this year. looking for a little bit more a sell-off, and then we're looking for $400 a share in Berkshire. This is sort of like the one-stop barbell portfolio. They have heavy weightings in energy, banking, and tech. They're the largest outside shareholder of Apple. Bonds are in absolute free fall. We've had the worst sell-off in the bond market in 40 years. Yields, actually, the yields are going up so fast. We hit 294 overnight. Mortgage refis down 67% year on year, thanks to a 30-year fixed rate mortgage that is top 5.0%. First 7 rate hikes are in the market, but the 5 after that aren't. Final target is a 3% overnight rate. We may hit that in a year. U.S. national debt is topping 30 trillion. That's the end of 20 years of deficit spending. Sell any 6-point rally in the TLT. U.S. Treasury bond funding. TLT could plunge from 180 in 2020 to 105 by 2023. And this has been our big winner so far this year. We went massively short in leaps or 1-year option trades with all of our clients in November, and they're just making fortunes in the TLT. So stick with that trade. 10-year Treasury yields, again, going through the roof, 294. And actually, we far surpassed this target a long time ago. So our 2022 target is going to be at least 3%, and we're almost there already. I may even have to raise my target to 350. Foreign currencies, we're seeing a dollar pop because of the sharply rising interest rates. Ukraine war has crushed the euro. Commodity currencies like Australian dollar and Canadian dollar had a huge run, but are taking a small break now. Russian ruble bounced back on oil pricing and capital controls. Currency with the fastest appreciating interest rates usually does best. Right now, that's the United States. Long-term fundamentals are still poor. Dollar short could be the new 10-year trade. We may have to wait another year for that one to get started. So stand aside for Forex now. There are better fish to fry. U.S. dollar basket, new all-time highs. You can see we had our last buy signal there. Oops, a sell there. And we're just standing side watching this ballistic move and the buck continue. Aussie dollar is our favorite play there, and we started buying around 60 cents here, and that has been a huge winner for us already. And again, over the long term, I'm looking for $30 in the dollar basket. Oops, I'm looking for 1-to-1 against the Aussie dollar and US dollar. So another 25% or so to go in the upside in Aussie. Bitcoin, we'll talk about this in a second. Energy obviously has had a massive wartime boost. If you're not in it now, it's too late to get in. It's way overbought. Biden has waived the ethanol rules. He's released 1 million barrels a day from the Strategic Petroleum Reserve to boost supplies. That could rise to 4 million barrels a day in the next few months, which is the maximum capacity of the SPR. But, it's a high-risk trade to be long here. What happens if Putin resigns or Putin suddenly declares victory and pull all his troops out, having, gained a few yards of territory in Ukraine after taking enormous casualties and losing a quarter of his army? So I'm avoiding all energy plays. The easy money has been done, and I'm in the easy money business. I'll leave the hard trades for the other guys. Oil, yeah, we see another run at the highs, but after that it collapses as it eventually gets replaced by electric vehicles and other alternatives. And this downtrend has actually been going on for 20 years. You see oil peaked in 2008, right at 150, and boy, I remember that day because that was the short of the century. And since then, we've been on a steady downtrend. We got all the way down to negative numbers, negative 37 in the futures market 2 years ago. Since then, blasted up to a new high at 132, and we may be already on the downtrend. We just don't see it in the short-term trend charts yet. Precious metals is in a new uptrend. Gold is the new flight to safety assets. Successive half points rate increases that Powell's been threatening absolutely do not work for gold. Many analysts are now raising their targets for the barber's rally now that Bitcoin has utterly failed to provide protection against absolutely anything. Wars, inflation, economic slowdown, pandemic. Bitcoin has fallen in every case. Rising interest rates bode poorly for precious metals as it raises the opportunity cost for non-dollar yielding assets. Stay away until this plays out. Silver is the better play because of enormous demand from electric vehicles and solar panels. Gold, here is your modest uptrend. It looks like we've had some sort of a short-term breakout here. And I think we will keep rising, possibly as much as $3,000 an ounce by 2023. So you get any retracements back to this level here by that dip. Barrick Gold has hit new all-time highs. See the buy signals we got here back in December and here. And the iShares Silver Trust. Silver is also having a good move. It's risen already from 19 to as high as 25. So don't play with matches. You could probably do okay just buying all the stocks I just mentioned and forget about them. However, the reality is the conditions for these companies change every day. They are all viciously competing, trying to put each other out of business. If you don't get daily updates on the fundamentals, you could easily get wiped out. Today's big winner could instantly become tomorrow's loser. That's why you need somebody like me to guide you through the thicket with and avoid an out-of-the-blue blow-up. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income. Go from complete beginner to seasoned pro in weeks. Learn how to quit your day job and trade full-time for a living. Trade from anywhere, anytime. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. And to show I can trade from anywhere, this is me sending you a trade alert from the coast of North Africa. And I'm trying as hard as I can to smile because it's 120 degrees in that picture. Hard truth is, you really need my help. The majority of individual traders lose money. They lack correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. And why are dead people so good at trading? Because they never sell. In my lifetime, the Dow average has gone from 600 back in 82 to as high as 36,000. And if you were dead that whole time, you made a ton of money. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. All you have to know is the 5% that's really working. There are a few great sectors and a lot of awful ones. You can earn a 10 times return on the great ones, but get wiped out by the losers. Let a 50-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. Bill was a struggling tobacco farmer in Virginia who wanted to supplement his fading agricultural income. After making $3.4 million with my trade alerts, he still farms, but he's growing grapes in California's Napa Valley for the high-end wineries. Philip was tired of working in the boom and bust of the oil and gas industry in Texas. After following my trade alerts and doubling his money every year for several years, he now earns a generous living as a full-time trader. Richard made millions religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast, as I did in that earlier video. Greg turned $100,000 into $1.5 million solely on my trade alerts. He bought a new home in California with Tesla solar panels, Tesla Powerwalls, and a Tesla Model 3. Still had enough money to send 3 kids to college. So what do we do about this? Well, stocks, you want to sell the rallies for the short term. Bonds, you want to sell rallies. Commodities, buy the dips. Energy, stand aside. Currencies, I would stand aside on that now. Precious metals, buy the dips. Bitcoin, buy the dips. If you were not up 68.89% in the past 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. 68.89% was our trailing 1-year return, and you can do this too, or even better than this. And of course, that's our average annualized return, 44.36. You get those kind of returns, you do things other people don't get to do, such as take the Queen Mary from New York to England. When you get to England, you can ride the Orient Express from London to Venice, Italy. And once in Venice, you can go island hopping in your own personal helicopter. Yes, this is what good trading can get you. Believe me, I can vouch for that. So here's a very long view. Here's where the big money will really be made. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That will create an economic boom that will last another decade starting in 2021. And if you think I've been smoking something, this is what happened the last time we had a demographic wave identical to the one that we're having now. That was from 1982 to 2000. During that time, the market went from 600 to 12,000, or up 20 times in 18 years. Are you ready for a replay of this market move? Well, if you take that kind of performance, use 2009 as the bottom, go forward 18 years, that takes us to 120,000 by 2027. Yes, that sounds impossible, except that we're almost there already. If you count this as the 2009 bottom, we're here now on a relative basis, and we're only one more triple away from hitting my, or quadruple away from hitting my 120,000 target by 2027. So yeah, this is what demographic tailwinds are all about, and it's delivering this time exactly like it was last time. Except this time we have a technology turbocharger. Tech is hyper-accelerating on all fronts simultaneously, and the pandemic greatly sped up the rate of change. The development of a functional quantum computer means that computational ability is about to increase 1 trillion-fold at no cost. The world's major computational challenges will shortly be solved, such as weather forecasting and cancer cures. All major human diseases will be cured within 10 years. Live another decade and you may have a shot at living to 150. Needless to say, the barbell stocks dominate in this scenario and will account for the bulk of stock market gains in our lifetimes. The 90s had far cheaper computers, cheap operating software, and a new internet. The 2020s will have 10 times this number of new technology drivers. So who will tell you how to play the next 85,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top trade mentoring service in the industry, up 68.89% in a year. Follow my research and market beating trade alerts, and you will rake the profits in. Let a Marine Corps combat pilot steer you to big profits. Single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, precious metals, real estate, and of course, Bitcoin. This is a typical trading month for us with our market timing index. You can see we did 11 trades in January, 10 of them made money. And here you can see we bought the S&P 500, made 16%, got out of that quickly, shorted the US Treasuries, bought the Russells, bought Amazon, bought Apple, bought Biogen. Oops, stopped out of Biogen quickly. We never run losses. We stop out very quickly because we know 95% of the time the next trade will be a winner. Then we bought Palo Alto Networks, shorted the Japanese yen, shorted treasuries again, bought the SPYs, and bought gold. It's just a matter of time before barbell stocks break out to new all-time highs. Watch this space melt up to the end of 2022, get ready to start reeling in those whoppers with Global Trading Dispatch as your guide. And yes, that is a 24-inch range bow trout, which I caught in northern Nevada. Here's how our trade alert service works. We in 2020, we saw an opportunity to buy Tesla at $200 a share. So we sent out a trade alert that said buy Tesla. And here it is, buy Tesla at 202 or best, opening trade. And for a portfolio weighting of 10% on a model $100,000 portfolio, you needed to buy 49 shares. What happened to Tesla after that? Okay, let's see. It went up 63% in 20 days. We thought the market was overbought for the short term, so we sent out a trade alert to take profits. This is what that looks like. Tesla, take profits, sell at $349 a share or best, closing trade. And on this trade, we made a profit of $7,203 in a little more than 2 months. After that, we just stayed at it. You know, we kept buying every dip in Tesla until it went all the way up to 800, and then we stood back. So yeah, this is how my friend Greg turned a $100,000 account to 1.5 million by buying every one of these dips in the options market. This is a history of our 10 baggers that we had in 2021 last year. Zoom, we recommended it 60, it went up 10 times. Lam Research, we recommended it 51, up 10.6 times. NVIDIA, high-end graphics cards, recommended it 38, it went up 16 times. Square, we recommended at $10, it went up 25 times. Moderna, we recommended pre-pandemic, and it went up 40 times. And of course, the granddaddy of them all, Tesla, by the time the final peak was hit, it was up 400 times. With my Mad Hedge Global Trading Dispatch service, you get instant trade alerts sent out at market sweet spots, about 200 a year, and all the reasons to execute them. Live bi-weekly strategy webinars and an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, more educational videos and webinars than you can consume in a lifetime, and access to a 14-year database. I'll even give you the name of a good surfing camp in North Africa. Watch out, it's harder than it looks. I think I broke my nose not long after this picture was taken. This is the one-stop shop. Learn all you need for every level. It's for individuals who want to understand what is happening with their retirement funds. It's for people who want to learn how to trade for a living, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in while the melt-up is coming. This is my daily research letter, Global Trading Dispatch, and it shows you all the reasons for what we're doing in the marketplace with our trade alert service. You also get Mad Hedge Hot Tips, the 5 most important things that happened every day in the market and what you should do about them. This is in your inbox every morning when the market opens. You also get stocks to buy for the coming Roaring 20s. A book I published a few years ago showing you which stocks to buy for those ballistic returns. This is what I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $10,000 a year. That's what I charge my concierge clients who get my personal cell phone number. And I'm not going to charge you $3,000. That's the full price of what I'm offering you on my website. This is the real deal. Creating this product cost me millions of dollars. With the best customer service in the industry, running it cost me millions more. 6 months for just $994. That's a 66% discount. But I can only, this is a limited time offer. I can only take 25 new subscribers at a time. So it's first come, first serve. I can't wait to make you a top door trader. Click on the link on the chat box below, which David should put in there right now. That'll take you to a dedicated sales page, which is the only place you can get this offer today. Let me make the money for you to pay for your subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Just click on the chat box on the right. 6 months for just $9.94. Buy now and you will instantly receive a trade alert with an extremely high probability of success that you can execute in the market immediately, since the market's open right now, and make some of the most serious money in your life. Don't leave good money on the table. 95% of these trade alerts make money. And if you, just as a teaser, this is a chart for that trade alert. I'm not going to tell you right now whether this is a buy or a sell. I'm just going to show you the chart with the prices and the names stripped out. All you can see here is the trend. Subscribe now to find out. You have to go through 1,000 charts to find one that's good. Let me do the heavy lifting for you. And let's go on. Let's go ride airplanes again. Oops, let's go again. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars, and I'm not allowed to tell you who. So it was in that spirit I made my way down to the famed beachside community of Malibu, California, to meet long-term Mad Hedge follower Richard Zeiler. Richard is a man after my own heart, plowing his millions in trading profits into a ground-up restoration of a 1929 Travel D4D biplane. This particular plane is quite famous because it was featured in a 1930 war movie, Hell's Angels, which won an Academy Award. However, Richard had to buy 20 other Travel Airs to get the parts needed to return this one airplane to flying condition. The modernized plane has a 300 horsepower engine, carries 62 gallons of fuel, and can fly 550 miles in 5 hours. Since I'm one of the few living tailwheel qualified pilots left in America, Richard was happy to let me have the plane for an afternoon where me and my kids buzz the surfers and RVs on the California coast. Let me make millions of dollars for you as well, as I have done for thousands of other followers over the last 14 years. I look forward to working with all of you. And this is the actual plane in a shot from the movie. That's your D4D Travel Air, although it's been substantially cleaned up since then. And you can see on this plane, that's the camera plane shooting a 1929 film. So again, 6 months for just $994. Click on the chat box on the right to get to the dedicated sales page, and I will now take your questions. Question number one, is the service useful for trading options? We have quite a large share of our followers trading options only. Every trade alert we send out gives the choice of buying a stock, an ETF, or an option. That way you can pick and choose depending on your own experience level and risk tolerance. And obviously, the more risk people take, the more they make. Every year we get several people who get 1,000% returns, which is a 10 bagger or 10 times return on their trading activity. It's more common to come in close to our own average annualized return of 44% a year. And most people will take that, especially this year when the market is down. And by the way, we're outperforming the market this year by about 35% since January. Okay, let me see what other service. Okay, David's got the link to the sales page up there. Let's see what other questions we have. Let me see if any others have come in by email. Oh, well, I can see we've already gotten quite a few orders in, so we're going to hit that 25 limit pretty quickly. Just let me see who some of these people are. Let me open up the email, and we have Anthony from Phoenix, Arizona has just come in as a buyer. Thank you very much, Anthony. The trade alert should be in your inbox right now. So look in your email. If you don't see it, it may be in the junk folder as it's coming from a new source. So congratulations. I look forward to working with you, and you're about to get the education of a lifetime. Okay, let me see who else has come in. Okay, getting a lot more orders in now. This is from Dennis from Overland Park, Kansas. We have here Mark from Belgium has just come in. Thank you very much, Mark. Promise to work hard for your money. And we have here another order from Robert in Houston, Texas. Thank you very much, Robert. Look forward to working with you. Check your inbox for the trade alert. We have, let's see, who else do we have here? Takes a little bit to open up these emails. Okay, here's another question that's come in. Do you think inflation is transitory, or are we headed for a double-digit inflation over the long term? The transitory argument went out the window with the invasion of Ukraine. Obviously, global shortages on our most important commodities like oil and wheat are going to have a huge impact on the inflation figures. About half of the increase in prices in last week's number was due to higher gasoline prices, and that's going to continue. So when the war ends, the inflation ends, essentially. That could be this year, maybe next year. If it doesn't, it'll cause a recession, and that will end inflation pretty darn quickly. So we could see, I expect inflation to drop to maybe 4% by the end of this year, because a lot of the one-time only prints and high prices are already winding down, like high used car prices. But we may have a double-digit print before then. So hold on, and that may give us, by the way, our final bottom in the stock market once the current rally ends out. Let's see how we're doing on stocks. Okay, got that. All right. Let's see, any more questions here? Can a basic beginner do this? Someone is asking, and the answer is absolutely yes. We started this service during the financial crisis 14 years ago, and there were a large number of people who just lost their jobs. So we literally had thousands of people come to us asking us to learn how to trade. And so we really geared the system toward the basic beginner. But in reality, the service is used by everyone from a college student operating from a dorm bed to a hedge fund manager running a $20 billion hedge fund. So we really try to satisfy everybody in that respect. Okay, any other questions here? When do you think the market will bottom from its current correction? And sometime this quarter would be my bet. You're seeing these, long grinding sell-offs followed by very short, sharp, short covering rallies. This week, we're getting another example of that. Clearly, this was triggered by the end of the face mask mandate required of the airlines. So that obviously unleashes all of the reopening stocks like cruise lines, airlines, hotels, and casinos. But it's also going to lead to an increase in COVID cases, and that alone could bring a reinstitution of the mask requirement and 1,000-point sell-off in the stock market. I'm sorry, but that is the most likely outcome of this action. Okay, any other questions here? Okay, David, do you have any more questions yourself? Can you hear me?
I can hear you. I'm not seeing any more questions.
Okay, let me just go through my other emails and see which other buyers have come in. Let's see, we've got Tracy from Grand Junction, Colorado. Thank you very much, Tracy. Look forward to working with you. Check your inbox. We have Michael at Corpus Christi, Texas, has come in. Thank you, Michael. We have Peter from Shreveport, Louisiana. We have Jeff from Plattsburgh, New York, has just come in. Thank you, Jeff. We have Judy from Memphis, Tennessee, and we have a Seth from New York City. Okay, let's see what other, okay, I'm just gonna check my email and see how many other questions. We usually get a lot of people emailing these questions at the same time, so just hang on and I will get to those. We can answer questions all day long here. Okay. Here's one. What are your thoughts on ground level small businesses like restaurants and mom and pop stores? Is there a silver lining in this environment? I would say that if you survive the last 2 years of shutdown and mask requirements and COVID, your outlook going forward is fantastic, because we are about to have a decade of unrestrained economic growth once the war gets out of the way. So I would say the outlook for the small mom and pop type businesses is very good. What's the opinion on the yield curve inversion, and what does that mean for the market? Well, this is the problem. All recessions have been preceded by yield curve inversions, but not all yield curve reversions produce recessions. In fact, only about half of them do. So I've been arguing that this is one of those non-recession recessions that's being predicted by the yield curve inversion. And of course, a yield curve inversion is where it's cheaper to borrow money for 30 years than it is for 2 years. And that is the case right now. If you look at your 30-year bond yield, it's actually lower than the 10-year, the 5-year, and the 2-year. Part of that is due to us unwinding an artificially low interest rate situation that really has been in place since the 2009 crash. So that's part of the reason. But also there's been massive spending, originally to reflate the economy and then to fight off a COVID-induced recession. And that caused the national debt to go from 20 trillion to 30 trillion in 4 years. So these are all reasons why interest rates are going up that may not necessarily cause recessions. Okay, let's look at another question. Someone says here, raising interest rates in this environment doesn't really matter, since interest rates won't produce more wheat or more energy. It's largely a supply side issue. Do you think it's better for the Fed to just continue with 25 basis point rate hikes because of what I mentioned? Answer, no. I think the Fed should go to 50 basis point rate hikes for several reasons. One, we have an artificially low, unnatural interest rate situation, which can't continue. Otherwise, it will create enormous and unsustainable inflation. Believe me, I was around the last time that happened in the 1970s, and you don't want that kind of economy. But also, for selfish reasons of my own, the quicker we raise interest rates, the quicker we get a bottom in the stock market. That's tradable. And once we do hit bottom, then you can go into the higher leverage type trades, which are best in that situation, such as leaps, 1-year options, and higher leverage positions. Okay, let me take one more question here. What are your thoughts on the unionization of workers like we have seen with Starbucks and Amazon lately? Why is this happening and will it continue? I don't expect to continue because Amazon and Starbucks can always fight off unions by raising wages. And Amazon did exactly that in Alabama. They gave everybody 100% rate rise, and it killed any union efforts right then and there. And they can continue to do that. And in fact, the number of Starbucks shops that have unionized is something like 5 now, out of a global store presence of 25,000 stores. And for sure, the international stores, won't unionize at all because unions are illegal in a lot of foreign countries. Okay, well, I think that's it for today. Again, if you want to sign up, click on the chat box on the right to the link that take you to the dedicated store. And that is pretty much it for today.